And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. The ETF community is abuzz about a new development that could lead to another wave of money going into ETF funds. 20 years ago, Vanguard was granted a patent to operate mutual funds and ETFs as essentially the same share class. That allowed access to all of Vanguard's passive mutual funds in an ETF wrapper, and it was a factor in helping fuel Vanguard's rise as an ETF powerhouse. That patent is now expired, and others led by dimensional funds are lining up, asking the SEC to allow them to copy what Vanguard has done. Let's talk to one of the first guys in line. Gerard O'Reilly is co-CEO and Chief Investment Officer of Dimensional Fund Advisors. Joining us as well, Ben Slavin. He's the Managing Director and Global Head of ETFs for BNY Mellon. Gentlemen, thanks for joining us. Gerard, educate us a little bit. Well, why is this potentially important, having ETFs and mutual funds in the same share class? What does that mean? And you do have to get SEC approval for this. What are the chances they'll give it to you?
Yeah, I think that's the big story here, Bob, is that the SEC gave approval for this type of a structure to one firm 20 years ago and haven't given it to other firms since then. And there are many firms now, I think, that are going to try get approval for this type of structure from the SEC. And why would they do that? Well, it comes down to a very simple economies of scale argument, Bob, is really what it is at the core. And that if you can pool many different types of investors in one investment vehicle, then that gives you the potential to lower expense ratios and provide economies of scale and value for service to many different types of investors. And in this particular instance, you have investors who typically invest in mutual funds for their retirement accounts and may invest in ETFs for their taxable money. And those investors potentially could get the access to the same type of investment vehicles, the same investment vehicles, in fact, if indeed more firms were able to offer ETF share classes of mutual funds. So I think that it's a good development for investors if the SEC were to begin granting this exemptive relief to more fund sponsors around the country.
Would this be, well, it's a little confusing for people to understand this. The exemptive relief that was granted to Vanguard was for their passive funds. Is what you're asking for them to allow this for both passive and active? And why did they make a difference back 20 years ago?
So what we're asking for is for all of our funds to get that exemptive relief. And then if the SEC were to grant that, then it would be fund by fund and conversations with the mutual fund board to decide which funds to offer that share class ETF for. Our funds are not the traditional active funds in terms of stock pickers, Bob, but we do have a systematic approach that goes beyond indexing because we think indexing leaves some money on the table, as does that traditional stock picker approach. So our funds we often characterize as having the best of both in terms of some of the good characteristics of indexing and some of the good characteristics of active implementation. And so, yes, we're asking it for that. I think if you go back 20 years, Bob, there were very few, if no, ETFs that were non-index. Yeah. And what we've seen since the ETF rule in 2019 is 800 plus new ETFs come to the marketplace that are characterized as active or non-index ETFs. So I think the landscape, the ETF landscape, is very different today than it was 20 years ago.
Ben, what would this do for the ETF space? I mean, we've got, what, 7,000 mutual funds, some huge number. Could they all add an ETF share class to their funds at this point? I mean, a lot of fund families have already launched separate ETF classes, right? I mean, they've already done this. Do they really want to make it easier to move out of a higher fee mutual fund and into a lower fee ETF? Some people may not want to do this. Some funds may not want to.
That's certainly part of it. I think Gerard raises a great point. The industry has evolved quite a bit in the last 20 years. I think that's absolutely fair to say. But this could be a game changer for the ETF industry. You're right, there are thousands of mutual funds out there that theoretically could issue an ETF share class. The biggest untapped space here is really the retirement assets that are in the mutual funds that are more than $6 trillion in assets that really has been largely untapped by the mutual fund managers. And, really there's a lot of comfort here. Vanguard's been operating this for more than 20 years successfully. And the technology certainly exists from an ETF standpoint. And also this is very common in other markets around the world. So, this is something that could be a win-win both for the asset managers, but the shareholders as well.
But the biggest piece is the retirement business, right? I mean, how much money is there in the 401k? It's like $6 trillion, right? So the problem in the past is the ETF business can't break into that. Would this be a sort of backdoor way to do that? I'm trying to figure out what happens here.
Yep. Well, absolutely true. ETFs have had a difficult time breaking into the retirement market. But reality is that in this case, it just makes it easier and certain economies of scale to benefit shareholders who are in the mutual fund class who maybe have retirement assets, as well as the ETF shareholders, by sharing a common pool of assets. In addition, I think when we're looking at active ETFs, instead of starting from scratch, you're certainly in a position where the asset managers can start with that performance track record, which is incredibly important for investors to be able to do their due diligence as they're looking for different products, whether that be in their taxable accounts or the retirement assets.
Gerard, the SEC has to approve this. Can you give us some timeline? They haven't said anything, right? And what are the chances they'll approve it or not approve it? Or, game this out for us.
Yeah, this fits under a process called seeking exemptive relief from the SEC, and it's a reasonable process because mutual funds operate under the 1940 Act, which kind of governs most of how they operate. And from time to time, a manager will come with an idea that kind of sits a little bit outside that 1940 Act, but can be good for the end investor. And so you go through a process with the SEC whereby they give you exemptive relief in order to implement that good idea. There's no time frame under which the SEC has to grant exemptive relief once it's been requested. But typically you start to engage almost straight away with the staff and with the commissioners to explain why this could be a good development for the end investor. And, when you talk about the retirement space, for me, it's more of a case of those economies of scale and also the flows out of mutual funds that we've seen into ETFs. They don't have to happen. You don't have to have all that trading and all those unnecessary costs. If more managers can offer ETF share classes, it could potentially give the way for an investor who wants to have an ETF versus a mutual fund to exchange their mutual fund shares for ETF shares without actually having to trade. So there's lots of benefits that come with the economies of scale, and you can stay mutual funds in the retirement space and still get those benefits by pooling with ETF investors in the taxable space, because often they're the same people. It's not that they're different people.
It seems like it seems like a no-brainer to me. This would help a lot of people, and potentially, I mean, I don't think it would save necessarily money going out of mutual funds and into ETFs. But what concerns would block approval? So I've heard this potential conflict as that mutual funds have to sell shares when they face redemptions, and that incurs trading costs. But an ETF can instead hand a parcel of securities to an authorized participant. So there's different costs here. And I've heard it said the SEC is concerned about those different costs in the past. But all the shareholders would bear the cost of the portfolio there, and it would be uneven potentially. Is that a real concern overall, given the advantages here?
Yeah, there are some concerns that the SEC could raise, and the reality is we don't know for sure. It's been close to 20 years since the SEC has really publicly opined on this. But certainly this concept of tax contagion, where trading in the mutual fund could theoretically spill over to ETFs and create some capital gains. The reality is that, we think there are several ways to potentially mitigate that, and potentially think that both share classes, could theoretically benefit from having these two classes sit by side. Also, there are a few other issues that the SEC could raise. Again, I think Dimensional and others in the industry have done a good job trying to articulate or knock down some of those arguments. One is certainly around the potential for cash drag or the cross-subsidization of costs between the share class, making sure that there is no additional friction or cost borne by one share class or the other. The reality is most of those, especially in larger products, is de minimis. And we think, again, the benefits will likely outweigh any implications that there might be for shareholders around those costs.
It seems like a no-brainer to me. You get choice. You get tax advantages, you get lower costs. The trading really helps here. This seems to be a big help, Gerard, for a lot of funds who want to keep their mutual fund class. So I know Dimensional, you guys converted several mutual funds last year, in the last few years, to ETFs. Others have not. I guess, would adopting this structure provide a way to let investors choose their preferred share class? That seems to me what it is here, but I'm trying to figure out what the concerns might be.
Yeah, there's two big benefits here, in my view. One is choice, and I think that can be a benefit to the end investor. You've nailed it spot on. And then the other is the economies of scale, but also to the point of cash flows in a mutual fund. In a active or non-index fund, like what Dimensional manages, so it's broadly diversified, it's systematic, it has low turnover, we typically use cash flows to benefit all of the investors in the fund. If we get a cash flow from a client subscription or redemption or from a corporate action, we're buying stocks that we want to buy on that day and selling stocks we want to sell on that day anyway. And the cash flow actually makes us more efficient, not less efficient. So I think in this new world where you have a lot of non-index type strategies in ETF format and mutual fund format, cash flows can actually be a benefit to all. So for me, those are choice and economies of scale, and the benefits of flexibility, to me, are very straightforward, very obvious. And now the question is raising it high enough within the SEC that the SEC prioritizes the issue and hopefully, makes a move and does something good for all of the end investors in the industry.
Ben, I want to move on, Ben, and talk to you about active ETFs in general. This is something Dimensional does as well. They're having a moment here. Cash flow, 25% of total industry ETF industry cash flow in the first half of 2023 was active. That's a new record for a half-year period. What's driving this?
You know, active ETFs have come a long way, and we've seen this trend accelerate. So it's the flow, but also the product development has continued to accelerate in this space as well. So we've seen the majority of products launched in the ETF wrapper the last 3 years be actively managed of one stripe or another. And we also see this trend continuing from money coming out of mutual funds. Again, there's that trend again, right, that we're just talking about, but money coming out of mutual funds into the ETF structure, and that's exactly what we've seen this year. So some of it is investor behavior, just at where we're at this part of the market cycle. Others are just simply a structural shift in terms of how investors are consuming active.
It's money coming out of active mutual funds into active ETFs. It's not money pouring out of passive funds into active. This is the problem I have with this. Oh, active's coming, big story, like suddenly passive is losing. It's not. So, Gerard, much of this active category that attracting flows are dimensionals, right? I mean, you have a systematic, rules-based strategies that have active implementation. Stock picking it still doesn't work, I guess. I'm trying to get to the point here is that the active guys like to turn around and say, you see, active is fantastic. This means stock picking works again. That's not really what's going on here, right?
Yeah, I think there's a lot of different flavors of active these days relative to 10 or 20 years ago, where active meant stock picking or market timing. Basically, anything that's not an index these days is called active. And the data show that indexing leaves money on the table. It's too rigid. The rules are not adaptable enough to adapt to different types of market environments. And the data also show that traditional active, stock picking or market timing, also leaves money on the table. The way that we look at it is both of those have their strong points. And so we have the benefits of indexing, broad diversification, low turnover. We're not trying to outguess market prices, a systematic approach, and an active implementation in how we implement the strategy day in, day out. And so when you look at who's winning, who's losing out there, when we're gaining flows from many of our clients in the ETF side of things, often it is from index funds. Where they see that they can have the benefits of indexing, but in this type of a structure that doesn't leave as much money on the table. So I think that it's become a more nuanced kind of discussion, Bob, as just active, passive. There's lots of different shades and flavors these days.
But you guys have always, I call it passive plus, what Dimensional does. It's active, but it's a passive, and there's an overlay above it. I can't help but bring up a study I covered last week. There was a study done recently about long-term stock performance. I've never seen a longitudinal study like this, and it came to some rather remarkable conclusions. It looked at the entire global stock market, 64,000 stocks over a 31-year period from 1990 to 2020. I've never seen a study this big. It took years to do this, and it found that the majority of companies did not outperform Treasury bills over this time. Only a handful of stocks accounted for the bulk of the wealth creation in the stock market. Here's an example. 5 firms here, Apple, Microsoft, Amazon, Alphabet, and Tencent, which is a China company, accounted for 10.3% of the $75 trillion in global stock market net wealth created in that 31-year period. This is rather remarkable. And look at this. In this 31-year period, only 44% of U.S. stocks outperform U.S. Treasury bills. And Ben, what's remarkable is they studied 17,000 stocks in the United States, and some people wrote in and said, there's not 17,000 stocks. There's not even 5,000 stocks in the Wilshire 5,000. There isn't, because they're all gone.
Right.
They came and went over that 30-year period, highlighting the fact that companies come and go, and we tend to just emphasize the companies who are the winners, who keep staying in the S&P 500. But it's a rather remarkable study. I know this is tangentially related to what we're talking about, but I never failed to bring up the point that stock picking is really, really hard to do.
It's absolutely, and we've seen these lines blurring for quite some time, and I think the ETF has been the forefront of that. So certainly what Dimensional is doing and other really what I would call rules-based active or smart beta indexes, as they're sometimes called, are all trying to really find a way to gain some kind of alpha, obviously, in the market. And again, the ETFs have been at that forefront. That said, it really comes down to when an investor is looking at an ETF, a mutual fund, or whatever the structure is, it's that after-tax, after-fee performance that really matters. And if you look at the broad-based benchmarks, the S&Ps 500s, even the NASDAQ 100, certainly more recently, they're really tough to beat.
Yeah. Really
tough to beat, and especially over those 3, 5, and longer-term horizons. Not surprised at all to see that.
Yeah. Gerard, U.S. stocks are again outperforming. What is this, 12 years in a row, 13, something like that. A lot of investors are wondering if global diversification is still worth the effort. Now, Gerard, I know you're very big on this. You've said many times to me and on our air, global diversification is still worth the effort. Now, given plenty of U.S. stocks have global exposure already, why are you so persistent in that argument that you make about global exposure?
Well, consistent with the study that you just mentioned, and that's consistent with prior studies that find in any given year, any given time period, it's often a small number of stocks that drive the positive returns of the market. But the trick is you never know which of those stocks are going to drive those returns in advance. And it's the same at the country level. While you may have a 3 or 4 or 10-year period where one country has done well relative to others, investing is forward-looking. It's not looking in the rearview mirror. It's forward-looking. And you don't know over the next 3, 5, 10 year which country is going to provide that high level of performance. So just invest globally. Diversification is your buddy. You can get it relatively inexpensively these days with different types of investment vehicles. And it gives you access to many thousands of companies out there. And the truth is that you don't know which of those companies are going to be the winners from a price return perspective or a total return perspective in the next 5 or 10 years. But if you have a little bit of all of them, the data kind of support that on average you're going to be doing better than those that have concentrated portfolios.
Everything he's saying, he's preaching to the choir here. I'm, everything he said, I believe. Mean reversion is a powerful thing. It's about time. And yet 10, 12 years is a long time here. Is there a structural reason why U.S. stocks outperform? Does it have to do with our legal system? Does it have to do with how easy creative destruction it is to create and destroy companies here in the United States? There's got to be, I've had my own opinion, but there's got to be a structural reason this is happening to some extent.
I think
it's not all equal across, the playing field is not completely level.
Yes to all of that, I think, are all factors in why, or that might explain what's going on here. I certainly think, from a return perspective, it's also about the dollar. And obviously that's been a huge driver of the return profile for international investing. And now you just recently, obviously, we've seen the dollar rally. You've seen ETF investors come out of the market, not surprisingly, at least on those tactical positions. And that, for both equities and certainly on the fixed income side, is also another driver that is, really provides our unique position in the financial markets, given what, global investors may or may not view as the direction of the USD versus everything else. But all the other structural reasons, and then some, would apply here.
Yeah. All right. It's always fascinating to talk about this subject, two of the best guys in the business. But I got to leave it here. That does it for this week's ETF Edge. My thanks to Gerard and Ben. We've asked Ben to stick around and give us his thoughts on where ETFs are heading for the rest of the year. Remember, you can see all of our shows on our website. Every one of them, last 5 years, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.